99. 9% of people will lose their gold and silver. Are you next? Let me tell you why that's not just a headline, but a profound warning. We're not talking about physical loss. We're talking about a strategic value opportunity loss, and most people are unknowingly playing by the wrong rules. You see, central banks around the world are not simply dabbling in gold, they are in accumulation mode. According to the World Gold Council, a staggering 95% of reserve managers expect their gold reserves to increase over the next 12 months. Forbes +2, the Times of India +2. This isn't speculative buying. It's a deliberate long-term pivot driven by the hard realities of geopolitics, de-dollarization, and economic uncertainty. The Economic Times: these institutions are buying tons. Month after month, Poland added 12 tons just in April, and China continues its steady build. World Gold Council +2, World Gold Council +2. Meanwhile, retail investors, everyday people like you and me, often treat gold and silver like emotional insurance. They buy when it's trendy or when macro headlines are scary, without necessarily understanding the real forces behind global demand. But here's the key: central banks don't react the same way we do. They don't buy for a quick swing or a headline play. They are building reserves, not speculation. In gold we trust. Report the supply side matters too. Physical gold isn't infinite, and even as demand from institutions surges, supply constraints are tightening. Central banks are absorbing newly mined gold in a way that redefines price floors. In gold we trust. Report when retail participants step in. They are often competing against well-funded institutions that have far longer horizons and far deeper pockets. But risk goes beyond mere competition. If you own gold without thinking strategically, you expose yourself to real vulnerabilities: storage costs, counterparty risk, and the danger of buying at seasonal peaks when irrational fear drives demand. Meanwhile, the institutions orchestrating this accumulation are doing it with structure, discipline, and conviction. And make no mistake, this isn't just about gold. Silver, too, has its own nuance, but the foundational problem remains. Most people are not positioned to benefit from the long-term forces. Their timing is off, their risk underanalyzed, and their mental model misaligned. At the same time, global pressures are mounting. Inflation, geopolitical fragmentation, and the rethinking of reserve currency dominance are not hypothetical. These are existential drivers for gold's role as a safe haven asset. Forbes +2 Global Economy site +2 Central banks see gold as a strategic hedge, not a speculative bet, and that should change how you think about your own metal holdings if you want to avoid being part of the 99% who lose. Not by physically losing bullion, but by underestimating what true value means. You need to rethink your strategy. Consider your gold and silver as part of a long horizon reserve play, not just a fear hedge. Ask yourself, are you aligning with institutional behavior? Are you aware of supply dynamics? Are you factoring in real costs, risks, and time frames? Because in a world where institutions are quietly hoarding gold, the only way for retail investors to avoid being marginalized is to think structurally, not emotionally. If you don't, there's a very real chance that when the next wave of demand comes, you'll be the bystander left holding shiny metal, but missing out on the real strategic gain. Most investors think gold and silver are simple store of value plays, a safe haven they can tuck away when things go sideways, but that's exactly where the trap lies. The metal itself is seductive, but unless you understand who's really driving this market, you risk being caught on the wrong side. The biggest forces in the gold market today are not retail speculators, it's central banks. These institutions aren't buying because they're panicked or tweaking portfolios, they're accumulating strategically and on a scale that few individual investors can match. In 2024 alone, central banks added over 1.0 tons of gold to their reserves, a remarkable pace that underscores just how deliberate their long-term accumulation is. World Gold Council +2 Access Newswire +2 in the first quarter of 2025, they added nearly 2 144 tons more, still well above long-term averages. World Gold Council, that should raise a red flag for everyday investors. Most of us are not aligning with the institutional playbook. We tend to buy gold when fear peaks, inflation surges, geopolitical headlines dominate, or the dollar wobbles, treating it like insurance. But central banks don't treat gold like an insurance asset. They treat it like a reserve anchor. Their buying is relatively price insensitive. They don't swoop in only when prices are cheap. Because their incentives aren't speculative, Access Newswire +2, Discovery Alert +2 on the supply side. This trend intensifies the danger for retail. The physical gold market is being squeezed. Mining, production, and recycling can only supply so much, and a significant portion is being soaked up by official sector demand. Access Newswire +1 as central banks steadily absorb newly mined gold. They create a structural bid, a kind of price floor that ordinary investors may fail to appreciate. Discovery Alert +1. When retail investors chase gold, they often underestimate hidden risks, the costs of storage, security, verifying authenticity, or even dealing with counterparty risk. Many treat their holdings as emotional safety nets. But if you're buying based on headlines or short-term fear, you're not playing the same long game. The real opportunity is long-term structural value, yet most retail investors lack that perspective. Then there's silver, which many believe is simply cheap gold. But silver doesn't enjoy the same institutional backing. It's far more cyclical, driven by industrial demand, and lacks a reliable reserve buyer like central banks. Access Newswire without strong support from sovereign institutions. Silver can swing violently, and corrections may be more severe. Analysts argue that silver's recent run could unwind sharply if investment flows reverse. Markets, Business Insider. Finally, we must factor in macro and geopolitical shifts. Inflation concerns, the de-dollarization trend, and rising political risk are pushing central banks to rethink reserve allocation, and gold has re-emerged as a geopolitical hedge. India Today +2. India Today +2. But retail investors, unless they're deeply informed, are mostly reacting, not positioning. So when most people jump into gold or silver today, they risk being outpaced, outmaneuvered, and left holding metal without understanding its evolving role. They're caught in the trap. They own physical gold or silver, but miss out on the real game, the long-term structural accumulation driven by the world's most powerful institutions. Most retail investors think that buying gold and silver is a foolproof way to safeguard their wealth, but they're ignoring a seismic shift in how the precious metals market actually works. What they don't see is the institutional machinery underneath. Central banks quietly hoarding record amounts, reshaping supply, and dynamics in a way that makes it very hard for the average investor to win long-term. Central banks added 244 tons of gold in just Q1 of 2025, according to the World Gold Council. World Gold Council +2 Bankygate. +2. This isn't opportunistic trading, it's deliberate structural accumulation. These reserve managers are not chasing short-term profits. They are building a foundation, treating gold as a strategic asset, not a speculative bet. Central Charts +1. That means that while retail investors panic, buy on headlines of inflation or geopolitical risk, central banks are methodically acquiring gold regardless of short-term price swings. Their demand is relatively price insensitive. Central Charts, meanwhile, physical supply is not infinite. The newly mined gold and recycled supply are being absorbed into official reserves, shrinking the pool available to everyone else. In Gold Witrust report, retail investors also underestimate the costs and risks. Storing physical gold and silver isn't free. Security, verification, insurance, these are not trivial. Plus, when you hold bullion, there's a counterparty risk. Without a strategic, long-horizon mindset, many retail investors buy as insurance or for fear, not because they understand the structural forces at play. Silver, meanwhile, presents its own perils. Unlike gold, central banks aren't accumulating it at the same scale. Silver's demand tends to be more industrial, more cyclical. Without strong institutional reserve accumulation, silver can swing much more violently. If investment flows reverse, retail holders of silver may face sharper declines. And then there's the macro backdrop. Inflation, de-dollarization, political risk. Central banks are using gold as a geopolitical hedge. Discovery alert, they're not reacting to short-term noise, they're making long-term sovereignty plays. Their motivations are different. Their time horizon is different, but most retail investors are still stuck playing the short game. Put simply, if you buy gold or silver because you're afraid, you're probably not aligned with what really matters. You're at risk of being outmaneuvered and outlasted. You may physically hold metal, but you could still lose, because you're missing the structural value that central institutions are capturing. Most people don't understand how dangerous gold and silver investing can be, not because the metals are bad, but because the real game is being played below the surface. While retail investors see gold as a safe haven or silver as a speculative bet, there's a structural force building a completely different kind of risk, one that few are talking about. First, central banks are quietly stockpiling gold in quantities that dwarf what individual investors can hope to absorb. According to the World Gold Council, they've added more than 0 tons of gold every year for the past 3 years, far above the historic average. World Gold Council plus 2, World Gold Council plus 2. This isn't panic buying, it's disciplined accumulation. Finance. Asia, their reason, gold is not just a hedge in their portfolio, it's becoming a foundational strategic reserve. In gold we trust. Report, because these central banks are buying so aggressively, a huge chunk of newly mined gold is going straight into official reserves. According to a recent report, public financial institutions are absorbing almost a third of all newly mined gold in some years. In gold we trust. Report, that means the supply available to retail buyers is shrinking, not because gold is running out, but because the biggest buyers are hoarding it for long-term stability, not short-term speculation. Now, when retail investors pile into gold because they're afraid of inflation or geopolitical risk, they're often not aligned with what these big institutions are doing. Their time horizon is totally different. People buying gold for fear or for short-term safety aren't thinking like reserve managers building decades-long portfolios, and that misalignment creates a dangerous blind spot. Retail demand may look like momentum, but it's fragile compared to institutional conviction. Then there's silver, which carries its own hidden risk. Unlike gold, silver doesn't enjoy the same level of central bank backing. It's much more cyclical, tied closely to industrial demand, and vulnerable to swings. Markets. Business Insider. Analysts warn that silver can correct sharply if investment flows unwind, because it lacks a structural buyer like gold does. Markets. Business Insider. And let's not forget costs. Owning physical precious metals isn't free. Storage, security, insurance, these are real issues. Many retail investors underestimate how expensive it can be to hold bullion properly. Add to that counterparty risk, verification risk, and even the risk of holding overvalued metal bought at the peak of hype, and you suddenly realize that safe haven isn't always so safe. On top of all that, macro and geopolitical dynamics are shifting. Inflation, de-dollarization, rising political risk. Central banks are increasingly viewing gold not just as a diversifier, but as a geopolitical tool. Finance. Asia plus 2, IPP Media plus 2. Their accumulation isn't reactive, it's proactive, positioning for a world where reserve currencies and power structures may look very different. Put simply, if you treat gold or silver as just a get-rich-if-things-go-bad bet, you may be missing the big danger. You could end up holding shiny metal, but being left out of the real value creation. The hidden trap is not in the metal itself, but in how you're thinking about it. Retail demand is emotional and short term, while the big players are strategic and structural. If you're not careful, you'll discover that the real peril isn't losing your gold, it's losing the opportunity to be on the right side of history.